What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online. Today I'm going to just take a look at a new short-term rental that was put up on Lofty. Give you some thoughts on that, but also just want to share with you some of the financial engineering stuff that they're doing that I think you have to really look out for. I think it is, borderline shenanigans as far as I'm concerned. I think that it is. I'm sure that there are people that are making bad investment decisions because they don't understand um, some of the structure and like there's really like the long-term implications of what can happen. But first, I want to show you this. I mean, this is like absolutely beautiful short-term rental. It's on Lake Michigan. The property itself looks amazing. Um, there is, it's already been operating. I found it on AirDNA, and I believe this is the actual, this is the property itself, it appears to be. It brought in 117,000 in revenue last year, and it seems like maybe it started in April, right? And so didn't have anything December, January, February, March. I think there's some possibility that maybe they use it as a long-term rental in those months because there was they're just saying $1,500 a month every month in the winter months. um it brought in 117,000 in top line revenue, and just as a reminder, this revenue typically includes cleaning fees and everything, so it's not, this isn't just the rental, it is that as well. But they're saying like, well, it was only available 233 days. So saying that that's the potential and the actual is a little bit problematic from that standpoint. But it makes me think, all right, it's probably a pretty good number. Um, when we look at their actual projections, they say 144,000, so a bit higher. But again, we were missing some months. They provided some full year projections, although this number doesn't match up with the 144. But then they are giving a rent credit, $47,000 in rent credits, and so then you end up with a bigger number. So I'm really not sure what they're doing there. Why this profit and loss projection that they're giving doesn't match up with what's going on here. But I think, I've seen that quite a bit on Lofty where they're just, um, for whatever reason, they have a hard time keeping their numbers straight on certain things. They don't always, they're not always using the same things that you would expect. And part of it is because a lot of this page just flows through by annualizing a single month versus actually looking at those projections which were giving us longer term. But the thing that I really wanted to focus on today is this rent credit, right? Like, what are they doing here? This is a property that's a seasonal property. I'd expect every January, February, March, April, and May to not be fantastic. So why are they giving a credit? It's not that they're not operating, and it's not that they're ramping up, right? I mean, this is a property that's already been a short-term rental. It's got history. There's none of that. So what they're actually doing is just trying to make the token more attractive, right? Like they're trying to make it so they can pay out a 15% yield, and that's why there's no numbers after the decimal point, right? Like, because what they're doing is the co-owner who's bringing this property to the site is just saying, look, until June, I'm going to pay enough. I'm going to make up whatever the difference is between what we actually collect in that 15% yield. And that's great. Like it's nice to get some free money, but it's not free, right? Like, why are they doing that? Well, it's because on Lofty, the majority of the investors really just look at what's the current yield, and that's how they price the tokens. And you might think, well, that shouldn't be what they're doing. But I think they're responding to a lot of the incentives in the way the site is structured, and so I understand why it happens. I think it's one of the reasons that there's just huge potential to buy discounted properties through the site. But it's also why it gets a little scary to hold, um, especially short-term rentals long term, because if you needed to liquidate some of these tokens and you were in the winter months on this where you don't have a yield, or your yield is very low, you're going to have a very hard time getting full price for those. And so what they're doing is saying, okay, well, we're going to just pay you extra money in those first few months so that people will pay full price for these tokens. It's just like syndicators do this. They will raise extra reserve funds and so they can start paying out cash right away when they're like turning around properties. I've always thought it's just not, it's not that it's dishonest, but you're not getting a true picture of the operation of the property. And I think that's what worries me because, you're going to have great early months and then next year they're they're going to be terrible, and you'll probably have a whole bunch of people dumping tokens because they don't understand why this last January was so much better than 2026 January. This will end up being. Oh, excuse me. So that it worries me a little bit when they do that. They've done it there, and then this is another property. This is one that a co-owner that's brought some properties to the site. He's also offering a rent credit on this one. But in this one, I actually think it makes a lot more sense because what he's doing here is he has several properties on this same block, and he knows how they operate, and he knows what you should expect from these units because he's using his other units as comps. And he's basically just giving the rent credit because this is one that they're getting a long-term tenant out and he's going to convert it to short-term rental. And so during that time, he's doing it. And so I'm a lot more okay with it in this type of scenario. Like, I think there are certain times when it makes sense to use a rent credit. And I really think that from what I've looked at, most of the time on Lofty, when they're doing it, it's more this type of scenario. Um, Not always, but I think that it's important to realize, like, is that credit just trying to bring the property up to what you'd expect it to operate at, or is it bringing it to a level that is unrealistic to expect going forward? That's my big qualm with doing it here, right? Is because it's going to make your initial yield much higher than your yield's going to be a year from now at the same time. Now, that's not terrible with a property like this because when they're talking about your projected annual yield, that's taking into account your full, those really good months and your not great months. And so over the long run, if you hold that token long term, you'd expect that your average would equal somewhat like that. But unfortunately, the way the trading works on the site now and the way that people value tokens, the value of the tokens fluctuate wildly. So until they figure that out, and I have some ideas, they could do instead of paying out whatever last month's was, you could accumulate cash in there and pay, starting in your good months and start paying out trailing 12 cash flow, right? You're like your average versus um versus like just whatever last month was. I mean that might be really tough to work out exactly how you would do that, but the other thing is to just report it differently, right? Like, okay, maybe you're not getting paid out this month, but we don't just drop the rental yield to zero in the reports, which is what they're doing now. Um, there's quite a few examples. One more I wanted to mention just because I've talked about this quite a few times, and this isn't a rent credit issue, but it's something sort of similar that was happening. I've done a couple videos on this universal lending DAO, where it's debt to the other entities, and we just found out this week that they were really what they were doing it in error, and I think that they're going to fix it and hopefully make things right. But what they were doing is making loans, and then when they would collect the payments, they would send the interest and the principal back out to the people that bought the tokens. But it wasn't disclosed that that's what they were doing. So it made the yield look like just amazingly high but what they were doing was they're really just paying you back your own money and calling it yield. And so, um, you know, I, I don't think that they have any ill will. I think that they're just not finance guys, right? Like you have a lot of very smart tech guys on this team, but there's nobody that, at least when I talk to them, that really strikes me as like being like I think most real finance guys would have just immediately seen that and been like, no, that's not what we're supposed to be doing. And so that I think that's where, and I started when I started talking about all of these fractional real estate investment sites. That was sort of my thesis to begin with, right? Is that like all of these platforms are very tech heavy founders and very few real estate slash finance people. And so I think it really shows. It shows in the way some of the property stuff is reported. It shows in the way, even just when you kind of have conversations with some of the people, just the way they think about things just a little bit differently than what I think the average real estate investor would think. Um, but anyway, I think that it just is something that you really have to look out for. So like I got caught up and I own some of this one, and it's I think at the end of the day I'm going to be fine, but it is it's just not it's just not what it looked like going into it, right? And so that's the thing. I am, it is why I'm not putting a ton of money on any specific property or even on the platform in general. I'm trying to spread money out through several platforms too, and really just at the moment using enough to where I can experiment, but not so much where it's going to really hurt me if some of these things go really awry. But that's exactly like what's happening in some of these is that I think people will buy these seeing that, oh, it's yielding this much in this month, and they'll they'll be very disappointed a year from now, and it's fully disclosed. I mean, they're not hiding it, uh but it is, people when they're coming on here, they're just trusting the numbers that are presented. There's a reason that this is presented so much bigger than everything else, right? Like they're trying to market certain aspects, and they, I think they know that people don't always read all of the details, and that's on those people, right? Like, but it is, if you wanted the fact that this came from a rent credit, that could easily be called out. And so that's one of the things I think that you really have to pay attention to. I think I said it already, but even though I think this is a fantastic property overall, it's not one that I would invest in personally. It doesn't mean it's not right for you, but it is because this gross rent relative to the investment value is just so low. I mean, we're routinely getting them in the very high teens and up to 20% here in San Antonio. When you look at revenue to price, at least I want it to be over 15. Like when it's operating, it's already furnished and everything, it's turnkey. I mean, I might go a little bit lower, but I at least want that to be 15%. And I mean, that is, well, let's do some math real quick. I always love doing the math. 144. And remember, we looked, and I don't even know where they're getting that number from, but we're just going to use it divided by 138,120. Oh, what do we do there? 144 divided by 138,120. Yeah, I mean, it's not even 10.5%. So that is just tough. You might say, well, then how are they paying out such a great yield, right? Like they're doing it the same way that a lot of these co-ownership properties are, and it's structured with some debt. Where there's currently, $628,000 in debt on it. That debt gets paid by this guy, Mark Johnson, who is the person who brought the property to the platform. That does not come out of the cash flow of the property, but the cash flow only gets split between the outstanding tokens, right? Remember how this works. So if you look at the full capital stack, there's 27,000 tokens, but that money's just getting split between the 15,000 at the moment because the rest are reserved for the debt. Over time, as that loan gets paid down, the owner will own more and more tokens, and so that yield will drop. And the yield will drop to the cap rate. But I want to point one other thing out here too, right? And so they're saying, well, okay, but this is an 8 cap, right? And that's fantastic if I really believed this was an 8 cap. But as with all of these that I look at, they're missing some important stuff. There's no repairs and maintenance in here. They have this property management fee, which doesn't make any sense at all, because if you look at their projections, we've got $27,000 in a property management fee. And so what wrong thing. So what I think is happening is they annualized some small fee, or they took this month's fee or something. I don't even know how they got such a little number. But so that, if you take this and you subtract this and you subtract the 27,000, we're already below 100,000. You add some repairs and maintenance, supplies, replacing furniture. Well, I mean, some of the stuff is capex, so it doesn't necessarily come out of your cap rate. But overall, the point is I think this number gets much smaller. Like, I mean, let's say, um, I think just with some mental math there, we could get down to 90,000 pretty easily. 3, 8, 1, 200. And so, yeah, maybe it's a 6.5 cap. Do I want to buy a short-term rental that's a 6.5 cap? Um, probably not. I mean, me personally, sorry about that. My screen recorder froze up again. I know I keep saying I'm going to get a new one, and I just haven't taken the time to like find a good one. Yeah, so I was just saying, 6.5 cap. I don't love that for a short-term rental. Especially one that's so cyclical, right? Because if something goes wrong and you miss one of your real big summer month, summer, like something goes wrong in August or July, the property's down for 2 weeks and you miss out, on a huge portion of your revenue. It could be really problematic, right? And so, because of the extra risk profile with a short-term rental, I want the property itself to have a good yield, not just the token, right? And because over time, that token yield's going to go down. Um, so for that reason, I'm definitely not a buyer at $50 for this token. Now, like I said, it is. I really like the property. I think it's probably valued right. I don't think that they're just asking for some stupid amount of money for it. But again, like if you're going to buy it, take a look at that because I haven't spent a lot of time on that because I've ruled it out pretty quickly um, based just on that revenue to price ratio. To me, I mean, that's like the number one thing. Well, it's not the number one thing, but it's one of the things on short-term rentals that it's easy to check right away. And if it's not a number I'm happy with, it's easy to rule out. But so, I'm not going to be a buyer of this at $50 per token, but I will come up with a price where I want it. And my guess is when we get to next year and we're in October, November, December, and and the property's not paying out at all, I think the token price will go down. And now maybe it'll sell out and go to $70, and then during that time it just drops down to 50. Like that's possible, right? Like we have some. Um, let's move this guy over there. Did I freeze it again? Nope. Okay, good. It's just, a lot of times it's when I'm messing with that. So let's take a look here. You do have some, right, that have gone up above $50. And these typically tend to be ones that have, high yields. And so it's possible that this token will move up to the $60, $70 range. And then when the yield drops off, next year or late next year, um, it'll just drop down to $50. And then, okay, well, if you want to buy it, you got to buy it at that price. But that's fine. Like one of the things I don't mind just continually passing up properties because there are so many properties on here that I think are really good opportunities that I'm not concerned with missing out on a few that even though I'd really like to have this property in my portfolio, right? Like it's an awesome property itself. But the numbers for me just don't really make sense. And so that's why but the big thing I just wanted to point out is the way that those rent credits are. Um, when I think like I said, I mean, sometimes I think they're perfectly appropriate. Sometimes, I mean, in this scenario, it's really just to prop up the price of the token for the initial sellout. Um, and that's fine. I mean, they're paying you that yield. They're upfront about what they're doing. Um, it's probably because they're just bringing it to the platform at the worst possible time for the property, right? Like if they wanted to really kill it, they'd bring it in July or August and, be paying out some really ridiculous yield those months and, people would pay a bunch for it. So, it is really just the way the system works is causing people to make short-term decisions, and it's trying to combat that a little bit. And it's the co-owner being willing to spend some money to do it, right? Like he's basically saying, like, look, I think this is worth more. I'm willing to, give up some of my cash flow, or actually really just pay money out of pocket to do it. But it's because, that money is really coming from the fact that they're able to sell these tokens for a lot more than they would if they didn't do that. Yeah, I mean, I'm just always wary of financial engineering. Early in my career, I thought it was just like the coolest thing. I have a finance degree and really liked to structure deals to just like create high yield. But one of the things that's, I learned over time is the more structured something is like that, the more prone it is to break, right? Like, I mean, there's just um, when things go wrong, they just go more wrong when you have, leverage works both ways, basically. And in this scenario, I think the response maybe from Lofty is, well, no, it doesn't, because that debt has to be paid by the co-owner. But that's assuming, it's paid outside of the entity. But that's assuming, several things. One, that they're solvent enough that they can continue to pay that. Um, and also that they don't just pay it off and then just fully dilute you. There's just a lot of ways that it can hurt you. And so, I'm really, to me, it's really important it's one reason I'm just not making a lot of long-term investments on this platform. I actually more and more am becoming a fan of Mogul for the stuff that I just want to buy and hold. I am going to do another video on there as soon as I actually talked to somebody over there today, and they should have the analysis for the one I've been waiting on. Sometime tomorrow is what they told me, and so I think hopefully I'll have a video on that. Again, just because that's one that I'm starting to lean towards for long-term investments doesn't mean that that's the right answer for you. But obviously, I am still spending a lot of time on this platform, and it's because I think that these really discounted ones are the opportunity, right? Like this, I think is this the one I picked up? No, I picked up more of Denison today, which, I bought tokens. Well, I think I bought them below this $16 because this is the market price, but somewhere around $16. Remember, somebody paid $15 or $50 for these tokens at one point in time. And I'm getting them at 16, 17, 18. This is my average yield, which, I had bought some for a little bit more. But, I have average yields on a lot of these in the teens. And, it is just, it's sad that somebody lost 60% of their money on these, right? Like they bought them at 50, sold them to me at 18. Um, And now I don't think that that means I'm going to be able to sell these for 50 ever. But I think a lot of these, if we push to sell the property in real life, like this one's for sale right now in real life, and I think I'm probably going to get $30 a token on it, and I'm spending, my cost basis is 18.50 plus the fees, like around $20, right? Like, so I think that there's going to be, um, significant payouts when we can push these all the way to a real world sale, just like I've talked about it a few times. Or is it right here? Just like this Keeler property. And we did get an update on this. It is under contract that we have inspection scheduled. They've deposited the earnest money, so it's like a real buyer. Um, at the current contract price, this is going to pay out like, I think, high $30, 30, it was either 37 or $39 per token. So that'll be a really nice return on that one if that works out. And so I think there's all kinds of opportunities on here. I just don't know. I think that it's just structured. I think it's tough to buy these ones, and I have a few where, I am holding these for long term. I think that because of the reasons I talked about with the way the debt is structured and whatnot, that it's a little tough to do that. These are a couple that I think I'm still okay with because they do have high cap rates, even if it's all paid off, relative to what they are. I think they're very strong cap rates, and not all of them. I mean, this one I think I'll probably, I don't know. I'll give you more details on individual ones instead of just spitballing about the whole portfolio. Excuse me. But I'm gonna have a sneeze, and so I think it's just as good a time as any to end it. Really, my whole point, like that new property, don't really like the financial engineering that's going on. I'm gonna pass on it for now, but next winter, really looking forward to being able to pick up some of those tokens. We'll see. There's a good chance I'm wrong. If I'm wrong, I just didn't invest. If I'm right, I'll get get a better deal than what I got now. Um, and that's really it. So until next time, I am going to just keep making mistakes so that you don't have to.